And with that, I'd like to welcome you to Phoenixville Public Library and our Zoom presentation. I'm Mark Pinto, Director of Adult Services here at the library. And tonight's presentation we'll go over the basics of saving and investing money. And with us tonight is someone very knowledgeable about these topics, Katrina Boyer. She's the Investor Education and Coordinator. Let's try that again. The Investor Education Coordinator with the Pennsylvania Department of Banking and Securities. Welcome, Katrina. Thanks for Zooming with us tonight.
Thank you so much, Mark, for that great introduction. It's my pleasure to be here with you virtually. You know, the thing with virtual is it's just become such another way of doing life that it makes it a whole lot easier for us to be able to come together and learn about different topics. So I'm thrilled to have you here tonight while we're talking about the basics of saving and investing. Tonight I'm going to be we're going to talk about what the differences between saving and investing are. We'll talk about budgeting for the long run. Then I'm going to talk a little bit about stocks, mutual funds, bonds, and savings. And then we'll get to the really fun stuff in the investing snowball, where we get to actually hear about how that little bit of money that we start to deposit, that we start to invest can grow and grow until it actually means something that you have to have in your portfolio to be investing. So we'll cover that. And then at the end, I'm going to provide you with lots of resources, because the reality is that I could talk for hours and hours and hours and obviously not cover everything that we need to cover. So this is a very introductory session. And I hope that you will take the time to take the resources and learn more, or go to our YouTube channel and check out the recorded sessions we have on breaking down different types of investing and going into more detail. So hopefully you can check that out as well. But first I want to talk about the differences between saving and investing, because often the two sort of get a little bit, the lines get sort of mixed together. So I just want to make sure that we understand that when we're talking about savings, we're talking about putting money aside, whether it's in a savings account, a checking account, a certificate of deposit. It's at a deposit institution. Our money is typically insured up to $250,000 per account holder. And that's a place where we can keep our money for our short-term goals, like emergency needs, maybe some living expenses, different things of that nature. Some of our short-term goals, maybe we want to plan to take a vacation or those types of things. That's where we're going to put that type of money. Now, it's also going to be where we want to keep our money for 10 years or less. Oftentimes people think about investing and they don't necessarily realize that we need to be cognizant of the time frame that we're looking at when it comes to where we want to keep our money. Some people say you want to keep money that you need in savings that you need in less than 10 years. Other people say 2 to 3 years. It really is dependent upon how comfortable you are with your money. But investing, on the other hand, is not going to be insured the way our financial depository institutions are insured. And they're going to help us to meet our longer term goals. Maybe we're planning to save for our retirement, or maybe we want to help our children or our grandchildren with higher education. Those are all things that we might invest in so that we have that money much further out, more than 5 to 10 years. But it's really important that we understand the differences between the two as we get ready to start organizing our money. And when I talk about organizing our money, I'm going to say that bad word that talks about budgeting or planning how we're going to spend our money. Because the reality is, if we're in a position where we're going to be starting to invest, it's important that we know where our money is going before we get started. And so we want to sit down and we want to think about where all of our money comes in and where it's going. There are lots of different tools out there. I grew up, my dad had a budget ledger. and he could tell us what the electric bill had been for years before. But a lot of times we don't do that so much anymore. We may use a spreadsheet. We may use a software program. There are actually applications that we can download straight to our personal handheld devices that can help us with setting up a budget. So it's really helpful to know I've got this much money coming in and this is what I know is going out. And it can help us so that we can start to think about transitioning to starting to put money into those longer term savings goals for retirement, or maybe buying a home or something along those lines, that money that's going to be longer term for investing. So just to recap, short-term goals, less than 10 years, less than 5 years for many of us, help us save for emergencies like medical bills, car repairs, help us save for some of those short-term goals like a vacation. One of the things that I learned when my youngest daughter was getting married was that we started putting money aside into a savings account because we needed it within 2 years. But we started to put money aside into that account so we could help her pay for her wedding. But what we didn't realize is how quickly we would sort of stop thinking about that money. We didn't miss it as much as we thought we would. And so after she got married, we continued to put that money into that savings account. And just 2 years after that, we were able to pay cash for a vacation. So that's a really, a very specific short-term goal that we can meet if we just sort of step back and think about how we're going to do it. Excuse me. Again, longer term goals is where we're going to invest money that we can afford to risk in the short term. And that's why we say you want to make sure that it's that your longer term goals are 5 years or further out, because the stock market, and we're going to see some images, the stock market really does ebb and flow. So that's something that we have to be aware of, because if we suddenly see a huge dip in the market, our investments suddenly take a plunge and we get scared, and then maybe we decide to sell and cash out our investments. But if we just decide to step back and wait it out for that longer term, we'll see in a few slides that it actually comes back, and it comes back higher. So that's important for us to remember, because investing really is not a sprint. This is a marathon. We're in this for the long haul. Many people start investing when they are in their mid-20s, and they're not actually planning to even use the money until they retire at 60 or 65 years old. So it really is very long term. And it's important that we keep that in mind, because when we see headlines can be pretty crazy. We see the headlines say, I just recently saw a headline that gas prices in California are going to be up to $5 a gallon. At that rate, I'd be having to break into my investments in order to pay for gas. But we have to be careful that we don't pay attention to the headlines, that we focus on, again, that long term. So I do want to tell you about some publications that we have on our website, dobs.pa.gov. We have some fantastic publications. They're written by the authors of Kiplinger, and they are completely non-commercial investment guides, information on, like you see here, the 5 keys to investing success. It really does help you with sort of an overarching view of what it means to be an investor, and it can help you with understanding some other concepts that we're going to talk about, but just being able to understand that investing process much better is very helpful. So I would encourage you to check out our publications site on our website. So now we're going to talk about different ways to invest. And we always think about investing at different levels of risk. When we talk about risk, it's the risk of experiencing a loss through the market. So when we think about risk, stocks and mutual funds are considered the higher risk. bonds and bond funds are less risky, and then cash, certificates, and savings accounts are the least risky. But we're going to start at the top and just sort of talk through what those look like. I'm sure we all sort of have an understanding of what a stock is. A stock is a security. It gives you part ownership in that corporation. Typically, there are thousands and thousands or millions of stock that are out for each company. When you buy a stock, you own a small piece of that stock. You're part owner. But that doesn't mean that you can just walk in and decide to help yourself to the most recent Apple device because you're an owner in the business. Basically, what that does is it gives you that part ownership, but there are other people who are going to manage and take care of that business. But over the long term, and we'll see it when we see in just a couple of slides where we see the stock market, over the long term, stocks and mutual funds have a much higher rate of return than the couple percent or the 0.5% that we get when we are depositing money into a savings account. However, it's a lot of work to have stock. Many people believe that you should have at least 15 to 30 different stock if you're going to be what's called well diversified. So it's important that we have a strong variety, maybe different industries and sectors. Maybe you want to have own stock in clothing, in entertainment, in technology, in fuel oils, big and small companies, new and old companies. Old companies tend not to grow as fast, but they can be slow and steady. A new company may experience some big growth, but along with big growth can come big loss. So it's important that we have this variety of stock. And we call that diversification. We wouldn't put all of our eggs in one basket. We don't want to put all of our stocks in one market or in our favorite company. Because if one company isn't doing well, hopefully the others continue to do well, and you don't have to worry so much about the loss. So if you're buying and selling stock, when you sell your shares, it's important that you understand that if you bought a stock at $50 and in a few years it sold for $150, that is a price increase. You will have made a profit, and you will likely owe tax on that for the earnings. So it's important that you understand that caveat when you're looking at buying and selling stocks. Now, another thing that we have to look at is dividends. When a company does well, often they will pay out a share of the profits to their stockholders. The stockholders are those individuals that own those pieces of stock, and they may share that. They may issue a dividend. So based upon every stock that you have, maybe they'll pay a couple of dollars. The more shares you own, the higher your dividend payment is going to be. However, and you'll see it when we talk about the investing snowball, you have the ability to take that dividend check and spend it however you'd like. But you also have the ability sometimes to reinvest those dividends back into the company, so that now the next time they pay dividends, you're going to have even more shares so that you get a bigger dividend check. And you'll see that it really does make sense when we talk about that investing snowball. But I keep talking about the ebbs and flows in the market. The stock market really is very much like a roller coaster. If you take a look at this graph, you can see the ebbs and flows between 1991 and 2013. You see there in 2009, we really did have a big loss in the market. That's when the housing bubble burst, and everybody struggled with their mortgage payments, and our economy really took a hit. And you can see that very clearly in that graph. What you don't see, because this only goes through 2013, is that now the market is actually much higher than it ever was. And that's because the ebbs and flows overall, when you look at the market, the average rate of return is somewhere between 7 and 10%. So that's why we say not to panic when you see a headline that there's a market that's took a hit, because if you just wait it out, oftentimes the investment comes back and it's even stronger. And we're going to talk about adding to our dollar cost averaging, adding to our retirement into our investing accounts, even when the market's low. It's almost like buying stocks that are on sale, because when the market comes back up, then we're going to see that value really increase. So that's another concept that we'll talk about. But let's now move on and talk about investment funds, because I don't know about you, but I don't have a lot of time to spend researching, trying to find 30 different stock companies that I want to buy stock in. An investment fund is a pool of money that's collected by sometimes thousands of investors, and the money is collected, and then someone else makes the decision on how that is going to be invested. And it can be a live person, it can be a computer program that makes the decisions. But what happens is it brings it all together in these baskets, and then a whole bunch of people have a whole bunch of different stocks. So it's a really great way to have your investments diversified and be able to have lots of different, have your eggs in all the different baskets rather than just one or two. So sometimes people ask, why would I want to do an investment fund as opposed to buying and selling stock on my own? Well, the reality is it really is up to each individual person who wants to make those decisions. But some of the reasons that people invest in a fund rather than a specific stock is because that together we've got millions of dollars that we can invest. So we're going to be stronger together. Often, so when you invest in the stock market, or you invest in a mutual fund, or any of the other funds that we're going to talk about, there's somebody that's going to get paid. If you are working directly with a stock broker, that broker is going to get paid every time you buy or sell. So that's something that you have to consider. If you've got a professional who's managing your accounts, they're going to take a percentage too. With mutual funds and other types of investment funds, often the fees are lower, and you can also get into the fund for less money than maybe buying those single stocks individually. So that's something that we might want to think about as well. And then remember, I talked about the dividends. With a fund, any dividends that are paid out are automatically reinvested into the fund, so that we all have those better, we all get to start earning that more money. So those are some reasons that we might want to consider using an investment fund rather than buying our single stocks. And so it kind of comes down to this: would you rather spend hours and hours researching stocks to purchase individually, or are you more comfortable with finding a reputable fund and letting the professionals handle the hard work? You know, that's a question. When I was doing some finance classes, I actually really did enjoy taking the time to research different stock companies and invest my money. But it wasn't cash. It was, it was a project. So I really enjoyed it, but I don't know if I would have enjoyed it as much if I'd have taken a big hit when I invested my hard-earned money. So that's something that we have to think about. And believe it or not, there are many different types of funds. There are actively managed funds. An actively managed fund is a fund that somebody somewhere uses their intellect and their research ability to actively buy and sell different stocks to be in the fund. There are exchange traded funds, which are based upon the exchange. So all of the stocks in that specific exchange are in that fund. There are equity funds, which basically it's the equity that you have in other companies, and they all come together. And then there's specialty funds, which I think are really fascinating. So a specialty fund might be a fund that's all dedicated to technology, or maybe everything in that fund is cognizant of the environment. It's an environmentally responsible fund. There are even they're called target date funds. Target date funds are really cool because it basically lumps based upon when you plan to use your retirement. So let's say I'm planning to retire in 20 years. So in 2042 is my target date. That's when I'm going to want my money. So everybody else in the fund also is looking to have their funds in 2042. And what happens is in the beginning, when we're farther away from our actual target date, our investments are invested in, they're invested in investments that are going to make us more money. As we start to transition to getting closer to the time frame that we're going to retire, it's actually going to transfer money into investments that are less volatile. So maybe it will start to transfer things into bonds or cash accounts, those types of things. So it's really helpful to understand what your fund that you're investing in is going to be doing. And as I said earlier, we have some really great publications. There is a publication on our website talking about mutual funds and exchange traded funds that you can download from our website, or you can go to investorprotection.org. You can see there also where you can learn more about funds, because again, I actually did a whole 30-minute session just last year on funds, different types of funds, and what those look like. So we can talk and talk and talk, but the reality is I only have an hour. So let's move on and talk about
Katrina, we've lost you. We've lost your video. Your video is frozen. Can you hear me? Katrina, are you there? Uh-oh. We'll give it a minute and see if she rejoins us. Yep. Yep, we know, Lisa. Lost the audio and her video.
I was trying to tell Katrina. I don't know if she's.
Uh-oh, did we lose her altogether? Katrina, okay, I hear you speaking. I mean, I see you're lip reading, but you are muted. Right. Katrina, you there? You're still muted.
okay. How's that?
Hello there. Yeah, your video froze and you just disappeared.
Yeah, I think that we have bad weather here in Perry County, so that's probably what happened.
Okay.
So, I think I have switched over to a different internet source, so I should be good. Shall we go ahead and go on?
Yeah, you'll need to share your screen again then.
I thought I did. Let me
You're
try
only
one more
seeing
time.
you right now.
Well, aren't I just cute enough? Oh my.
That.
Wait, oh wait, there it is. Hold up. Now if my mouse will cooperate. Share screen. Here we go. We are going to do this. Ha! There we go. Now you should be seeing it, right?
No. Oh, wait a minute. There we go. Just popped up
All
now.
right. I am so sorry for that. So I think we were right at transitioning to bonds. Is that correct?
Yep. Mhm.
All right, cool. So a bond is a type of investment where you're basically lending money to a company who is using that money that you've invested to help pay for a big, large project. Oftentimes, local governments will issue a bond. They'll have a bond offering when they're trying to maybe invest in a water infrastructure or a power infrastructure. And basically what happens is you're buying a bond. It's basically lending money for a defined amount of time, and they're going to pay you the interest every 6 months. So twice a year, when you buy this bond, you're going to get an interest payment. And then at the end of the bond, you'll get your full payment back. So those are really, bond funds are considered less risky than stocks and other types of funds because they are more guaranteed. If you own stock and a company goes bankrupt, you've lost. In a bond situation, if you've purchased a bond, if the company or the municipality would go out of business or they would go bankrupt, bondholders are going to be paid first. So that's the difference. And it's not easy to issue bonds. And there are a few different types of bonds that we're going to talk about in just in the next slide. But there are really 3 reasons that people tend to buy stocks or buy bonds. Number 1 is they get that steady stream of income. That interest payment every 6 months can help to pay for taxes or insurances, or can be used just for general living expenses. But there also is, when you buy bonds and you include bonds in your portfolio is everything, all the investments that you have together. When you have bonds, you're helping to reduce the risk for your overall portfolio because there's little risk involved with bonds. And then also, when the economy goes down, when we saw in 2009, where we saw the stock market really take a hit, the reality was that the bond market stayed very steady. And that's where that can protect our portfolio from losing entirely in a down market. So that can be very helpful. It can really help to, again, spread out that risk so you're not running into risks that you don't want to take, or risk losing all of your investment portfolio. There are different types of bonds. So we're going to talk first about corporate and municipal bonds. Corporate bonds are issued by a private or a public corporation. They have a higher credit rating, so you're going to have a much less risk of the company not being able to make good on its payments. They're considered investment grade. High yield bonds are going to be issued by companies that have a lower credit rating. So they may issue bonds because they maybe can't get a loan from a traditional, from a business loan. They're a higher credit risk, but when you take on a higher credit risk, you're going to make a higher interest payment. But you have to weigh that risk with the benefit, because there is the chance that the company wouldn't be able to make good on its on the bond repayment. But keep in mind, again, that bondholders are made whole before stockholders, because you're considered a debtor. They owe the debt to you, so you're going to be made whole first. Municipal bonds are the ones that I talked about, like for municipalities. The city of Philadelphia a few years ago actually had a bond up for vote. They had to replace their water infrastructure structure, and they were going to issue bonds in order to pay for that. It was going to be a 10-year bond. And a lot of times municipalities may use it to just bring in revenue so that they can make road repairs or whatever. But again, you've got that higher potential for being repaid, and you may not earn as much in interest as you would if you were investing in the stock market, but you've got a much less, there's much less risk associated with that. So again, it's sort of that balancing act, and that's where we talk about having a diversified portfolio. And then there are US Treasury bonds. And, you know, a long time ago, I know my parents, when I was young, they invested because that's what Uncle Sam wanted them to do. But the reality is there are a few different types of bonds issued by the US Treasury. There are notes that are longer term, but they're less than 10 years. There are bonds that are longer, they're even much longer term. They don't mature for 30 years and interest is paid every 6 months. There are short-term bills. That is a bond that you can purchase that will mature and repay within a year. And then, as you can see here, there are Treasury inflation protection securities that mature at different time frames. So if you're interested in doing that, you would go and look for US Treasury bonds, and you would be able to buy them as you would, you know, other bonds. But what's really cool is that the reality is that people buy and sell. There's actually a whole market for buying and selling bonds, because sometimes bonds are issued and they're going to be good for 10 years, but the bond issuer has the ability to recall all the bonds if the interest rates change. So there's a lot of things to consider. And guess what? I have a publication for that. We have a publication that's all about bonds, and it can really be helpful. Again, I could talk for hours about bonds, but I don't have that much time. So let's move on. The main thing that I think we need to keep in mind when we're investing is that we have to control our emotions. We don't want to be long term, despite what the negative headlines say, because headlines can create this sense of fear and cause everybody to rush and do something, when the reality is, if we just step back and wait, we can see that the markets come back. And you saw that really clearly in the stock market, the S&P index that I showed you when we were talking about stocks. But now I want to talk about cash. That's the least risky, especially if we have it in a financial institution that's insured. But we're going to make very little interest. So if we're trying to grow our investment, keeping everything at a depository institution can be risky because you're not going to make that money. But we do want to have money in a deposit account, because there always are emergencies. When you least expect it, that's when the things happen. We were recently away for the weekend, and I actually had a hot water heater emergency that I had to get a plumber to do. But if I hadn't had money in emergency savings, I would have had to either put it on a credit card, or I would have had to pull money from my investment accounts to pay the bill. And that's not what I wanted to do. So having that money set aside for emergencies, maybe paying for the next semester of college, those types of things are things that we want to keep in those savings accounts. Certificates of deposits are, they remind me a lot of bonds, in that I'm allowing the financial institution to use this chunk of money for a defined amount of time in exchange for them paying me interest for the use of my certificate of deposit. So instead of paying every 6 months like a bond does, the certificate of deposit would be paid, the interest that you would earn on the CD is paid at the end of that time frame. So let's say I take $5,000 and I want to buy a 6-month CD. I'm going to buy that 6-month CD. The financial institution is going to use my money and they're going to pay me some interest rate. It's not going to be a lot because that's just where we are right now. At the end of that time frame, you have a choice. You can cash it in and collect the interest, or you can let it roll over and the institution will pay you again interest, and you can keep letting it roll over. The important thing to remember when you have a CD is that if you are getting a 0.5%, excuse me, if you're getting a 0.5% in this 6-month CD, when they renew it or roll it over, you may only get 0.25%, and they're going to send that to you in a letter that says your CD is going to mature on this date, and if you want to let it roll over, this will be the new terms. You're going to let it sit there for this long. And this is the rate that we're going to pay you. If you don't cash it in that time frame, and it's a really short window of time, it's like the week before and the week after the date of maturity. If you try to cash it in early or too late, you're going to pay a significant penalty on cashing that certificate in when it wasn't due. So make sure that if you're using CDs as a way for savings, make sure that you stay on top of those dates. Because I met a couple one time before I started doing outreach, I worked in our consumer services office, and I had a couple that missed the date to cash in their CD by like 3 days, and the penalty that they were charged was like 20% or something like that. It was an outrageous amount. So they basically lost all the interest they had earned and then some. So I think it's important that certificates of deposit can be really great for keeping our money away from us, but it's also really important that we stay on top of those dates, because we don't want to have ourselves in a position where we have to pay those fines, those penalties. So a lot of people ask me, how much should I have in savings, because they want to start investing. So when we think about what we should have in savings, a good rule of thumb is that we should have enough to cover our living expenses for 3 to 6 months. And that has to include not only our monthly payments like our mortgage and car payments and groceries, but it has to include some of those things that we maybe only pay once or twice a year, like our taxes and insurance. So it's important that we calculate that when we're looking at what we should have in our emergency fund. But we also want to have money for those unexpected emergencies, like my hot water heater suddenly not working properly, or if you have a medical emergency and maybe you have to go to a hospital or you have to go to the emergency room. Those can really create some big expenses, and it's important that you have the money available so that you don't have to dip into your investment accounts to pay for some of those emergencies. So that's sort of what we talk about when we suggest that you have that emergency fund set aside. So now I want to talk about asset allocation, and this is where we talk about how am I going to invest my investment money. So asset allocation is an investment technique that sort of takes risks and the potential for growth and sort of balances it out. Basically, you're taking your risk and what you're going to be investing in and sort of spreading that out so that if you're very far from retirement, maybe you want to invest solely in the stock market or mutual funds that are all stocks. But as you start to get closer to retirement, maybe instead of having 80% of your investments in the stock market, as you're starting to move closer, maybe moving that to 40% in the stock market, and then 60% in or 30% in mutual funds and 30% in bonds. So it's just sort of spreading our money out through the different categories, so that when one's doing really well, if another one isn't, it's okay. They sort of compensate for each other. It's just one investment technique. There are many. And on our YouTube channel, we have 30-minute sessions on different, there's a 30-minute session on investment techniques. So here's another thought process on balancing that portfolio. It is, you know, if you're 23 years old, maybe you want to have 23% in bonds and the rest in stock. But again, as you age, you start to move that so that you've got more in bonds and less in stocks, so that if suddenly at 65 you're ready to retire and you still got everything in stocks, and we hit a year like we did in 2009, we run the risk of having lost significant assets. So that's another way of looking at asset allocation. There are some things that we should know. There's a whole bunch more, but the reality is we want to consider the risk versus the potential for return. And we don't necessarily want to rely on only what the financial software tells us, because computers can be wrong. So, you know, we have to sort of think about things logically, and then really think about our long and short-term goals. What am I looking to do with this money that I'm investing? Do I want to invest and save so that I can pay cash for a house? I want to do that in 10 years, not 30 years. So maybe I want to have something that's not quite so aggressive. The thing that you have to keep in mind, no matter how old you are when you start, time is your best friend. And the more time you have, the more time you have to grow your assets and your investments. But at the end of the day, you just have to do something. And you have to just start doing something, you know, even if it's $20 every week or whatever you can swing. Getting started is the best way to ensure that you're going to be closer to your goals. So I talked about asset allocation as one strategy for investing. I mentioned dollar cost averaging a little earlier. So this is another example of a stock, of the stock market. To be honest, I'm not sure which. This is from Dow Jones, and it's through 2016, I think. But basically, I really am just trying to show what dollar cost averaging is. Dollar cost averaging says that I'm going to invest a defined amount of money every time I get paid, whether it's $50, $100. I'm going to show you a slide in a little bit what $84 a month can look like over a 40-year time frame. But basically, with dollar cost averaging, you're putting the same amount of money into your investments every payday. And sometimes when the market's really high, you're not going to get much for what you're investing. But when the market's down, like it was in 2009, that same amount of money that you were investing went a lot further, so you got more shares, and that helped to grow your portfolio. So dollar cost averaging really is sort of that. It reminds me of the little choo-choo train that could, and I think I can. He just kept plugging away a little bit at a time, and eventually he reached his goal. And so dollar cost averaging really does remind me of that. So compound interest. Interest on interest is really cool when you're making the money. And this is what happens is I've got X amount of money in my account, and over time, every time I get paid interest, then I have a higher balance. And what happens is over time, it really begins to grow very quickly. And that's where we come up with the investing snowball. You may have heard of paying off debt in a snowball fashion. You can also invest in a snowball fashion, where you take a little bit from every paycheck and you get interest on your savings, you get dividends to your stock funds, and you reinvest that, and over time you're earning money on money that you earned in your account, which is really cool. So the interest stays in the account, and then you start to get to that snowball effect. And the same goes with dividend payments. You buy more shares or more parts of shares, and it again adds to that snowball effect. So here's where we talk about, if I was to take $84 a month for 40 years, obviously I had to have started years ago because I'm too old to start now for 40 years. But if I take $84 a month and I stick it in a box somewhere for 40 years, I'm going to have $40,000. That's a nice chunk of money. But if I were to take that same $84 a month and invest it into a mutual fund or the stock market, if I compound that at an interest rate of 10%, which is a little high, but the over average investing in the stock market sees a rate of return somewhere between 7 and 10%. How does $469,000 sound to you? Which of these would you prefer, 40,000 or 400,000? That's how the investing snowball really does pay off. We may not see it early on, but as time goes by, we're really going to see that growth, and that's where it pays to be in investing for the long haul. So I do want to tell you about some of our other publications. When you are investing, you will need to hire a professional. Our two publications that we have for that are Cutting Through the Confusion and Getting Help with Your Investments. Both of those detail what you can expect from your investment professional, what they can and can't do for you, whether or not they have a fiduciary duty to do what's right for your investments. And all of that is outlined, and both of these publications are available for download on our website. And at the end, I'm going to give you my email address, and you'll be able to email me, and I'll be actually happy to send you out these publications, the printed versions. We have, again, and some more, the Maximize Your Retirement Investments really is all about making sure that you take the most advantage of any retirement plans that your employer offers, so that you're making the best out of your investments. Excuse me. So we are just about to the end of our session. Our consumer services office is available during regular business hours, and they're happy to answer your questions. If you have a complaint about your investment professional, you're not sure they're doing something right, if you have a complaint against a car dealership as far as the financing goes, or you have a problem with your bank or credit union, we're happy to help you with answering your questions. If it's an institution that we regulate, we are happy to mediate on your behalf to try to get some answers for you so you understand what's happening. I thought I had slides here on FINRA and the SEC, and I apologize because they are not here. So my name is Katrina Boyer, and I would encourage you, if you want to learn more about investing, go to Investor Protection Trust. They have some great publications. Check out our website, dobs.pa.gov. We have, I think, 40 or 50 publications on our website. If you go to our website and go to our YouTube channel from there, you can actually see all of those 30-minute webinars that I was telling you about. We did 30-minute sessions once a week for a year on all kinds of different investment topics, savings, home ownership, lots of different topics. So there's some great resources there as well. At this time, if there are any questions, we can go ahead and stop the recording, and we can answer any questions that you may have live or any questions that have come in on the chat. I'm not seeing anything on chat.
Oh, nothing on the chat. Thank you, Katrina. Great, clear explanations of all the concepts involved tonight. Really appreciate that. And so I thank you, and I am going to stop the recording now. So if people want to unmute themselves, they can. So recording has